they're not willing to give you any credits for your closing costs, because why would they? They have multiple buyers vying for their home. Why would they pay you to buy a house if there's other people looking to buy that same house? Hey everyone, welcome back to my channel. If you don't know, my name is Wesley Meyer. I am a realtor here in the Nashville area. This channel is all about Nashville real estate. I know it's been a while since I've uploaded a video here, but this particular video is super important if you're going to be buying a house from now for the next year or two, to help you understand what's happening currently and what's going to happen in the Nashville real estate market in the next few years. If you haven't already, please subscribe to my channel and turn on post notifications so you don't miss any of my other important videos. Right, so I want to start off today talking about interest rates. If you follow interest rates at all, you know they are going to be coming down. In fact, they've already come down. Earlier this year, rates were over 8%. At the filming of this video, rates are in the mid to low sixes. And so we're going to be talking about that. And this week, the Fed has already announced that they are going to start their interest rate cuts. I am confident in saying that rates are going to be coming down in the next month and the next few months steadily as the economy starts to weaken. This is not controversial anymore. Rates are coming down. So what does that mean for you as a buyer or someone who wants to own property or wants to own a house in Nashville? What does that look like? Well, I'm gonna go over a couple scenarios based on when you buy and what the climate in Nashville real estate is probably gonna be at that time. So let's get started. First scenario is if you buy a house this year. So it's September right now. If you buy September, October, November, December, the winter market here in Nashville. So let's say you wanna buy a house. That house is $400,000. For this example here, all these houses, we're going to be using the same loan. It's an FHA loan, it's a federally subsidized loan with a 3.5% down payment. So for an FHA loan, you're looking at about a 6% interest rate right now. It could be lower than that, but we'll just go with 6. So on a $400,000 house, right now, there still aren't that many buyers in the market because people are waiting for interest rates to come down even further to buy. So that means you as a buyer right now have a pretty good amount of leverage to negotiate with the seller. That means that the seller's probably gonna end up paying your title costs. That's about $2,000. It's not an insignificant amount. I'm seeing a lot of seller credits to help cover closing costs, fees, that kind of thing. You have a pretty good shot at having the seller pay for your agent's commission. Most agents charge between 2.5% to 3% commission on a purchase or a sale, and it is pretty standard that the seller pays for that. Especially right now, there's a buildup of inventory. The buyers aren't as active as they could be, so the odds of you getting your agent's commission paid by the seller are pretty good. So $12,000 to your agent paid by the seller. Let's just assume there's a little bit of repairs that are needed to this house. So $5,000 of repairs, you've actually negotiated that the seller can pay those too. That's not abnormal. Sellers oftentimes will pay for the repairs. Things that you would pay for. So your down payment, $14,000, and your closing costs. So I assume $12,000 of closing costs. You've already got this $10,000 credit here, so you have $2,000 left to pay for your closing costs. That's a grand total of $16,000 out of pocket for you to buy this house, and with a 6% interest rate, you're gonna be looking at about a $3,200 payment. More accurately, $3,180 monthly payment. That includes taxes, that includes private mortgage insurance. That's the full payment you would probably be making on this home purchase if you bought right now. So pretty minimum out-of-pocket expenses for a $400,000 house, and the payment is gonna be over $3,000. Now, this same house, so all these scenarios, you're buying the exact same house. So say you don't want to buy now, you want to wait till the spring when rates drop. I'm predicting rates are going to be significantly lower by the spring of 2025. So let's just say they go down to 5.25%. So 0.75 difference from right now. Because rates have decreased, more people can afford more homes. So there's going to be an increase of buyers, there's going to be an increase of competition for the same house. Know that anytime there are more buyers, there's gonna be increased competition and home values are gonna go up. When there's more demand, the value for that same house increases. So the home has increased to $415,000. You might have multiple people vying for the same home, so you might be competing with another buyer at the same time. That's what drives the home price higher. So we'll say the same house is $415,000. Same exact loan, 3.5% down payment FHA loan. Your interest rate is better here. The Fed has cut some rates. Rates have dropped a little bit, 5.25% interest rate. Your agent's good. You're still able to negotiate that the seller pays for title. That's a pretty common thing, but they're not willing to give you any credits for your closing costs, because why would they? They have multiple buyers vying for their home. Why would they pay you to buy a house if there's other people looking to buy that same house? So no credits on this one, but they are still, however, willing to pay your agent's fees, because it is a pretty common thing, and most people would not be able to buy a house if they have to pay their agent out of pocket. So the seller is paying your agent's 3% fee. And then repairs, you have negotiated to split the repair cost with the seller. So the seller will pay half, $2,500, and you will pay half. That's what the seller's paying. You, on the other hand, you have a $14,500 down payment. Now keep in mind your down payment's going up because the purchase price of the home is going up. You also have $13,000 in closing costs, and then that $2,500 for repairs. All that added up, your out-of-pocket expense to buy the same exact house as a few months before is now $30,000, because those increased buyers has increased the demand, and now you have lost leverage and you have to pay more out of pocket to get into the exact same house. The good thing is though, because your interest rate is lower, your monthly payment's a little bit better. It's not much though. That amount of savings is not very much. Your interest rate is almost a full percent better here, but your monthly payment, because you're paying more for the house, your payment, it's maybe about $100 better. It's $100 cheaper per month, but you're paying almost twice the amount out of your pocket to get into that house. So you see that pattern, it's just going to continue if you wait even longer while interest rates drop. So let's go through the third scenario. Keep in mind, this is the exact same house as these two, same house. You wait till the summer or the fall 2025, interest rates will be even lower at that point. Let's just say they fall to 4.5%. Great, rates are under 5%, buyers are flooding the market, people are able to afford more house because interest rates are lower, so there's a lot more people vying for the same house. This same house sells for $425,000 because there are now 3-4 different people all wanting to buy this house, and that increases the price because there's a lot of demand. Same exact loan, 3.5% down, interest rate 4.75. Let's see what the seller's willing to do on this one. They're not gonna pay you any credits. They have multiple offers. They're not gonna wanna pay you any kind of credits. They're also not willing to pay your 3% agent fee. They're only willing to do half. Why would they? They have a lot of negotiating power here. They're also not willing to pay title. So you have to pay title as well. That's what happens when you lose leverage when there's a lot of buyers in the market. So let's see how much this adds up to on this side. So you're paying the title expenses, that's $2,500. You're paying the other half of your agent's commission, that's another $6,370. Your closing costs are about $13,500. They're also not paying for any repairs. You have to cover all those. You're buying the house as is. They're not gonna be doing any repairs. So you're also paying that $5,000 for those same repairs, and then your down payment, $14,870. That brings the total out-of-pocket cost to purchase this house, $42,240. But hey, look, your monthly payment, it's even lower, $3,054. Now, I don't know about you, but if you ask me, saving $100 to $150 a month, going from here to here, is not worth the cost of $16,000 versus $42,000. If I can get into the same exact house earlier for way less out of pocket than this, I'm gonna do it. Yeah, sure, I'll have to pay $100, $150 more per month, but to me, that's worth doing when I'm saving so much cost up front. One thing too to keep in mind, some lenders will offer free refinances for a certain amount of time after you purchase a house. So in this scenario, you end up buying now. This is your scenario right here. You buy this house for $400,000, you put $14,000 down, so your total out of pocket plus closing costs is $16,000. Say you wait all of next year. Say winter next year, interest rates drop. They're gonna be going way down by then. Let's just say interest rates are at 4.5. If your lender offers free refinances, that eliminates a lot of the risk for you. So you would still be able to get into this house for cheap with getting your closing costs covered by the seller, getting those repairs paid for by them, getting your agent's fee covered by them, you'd pay very little of those actual costs, and you'd be able to take advantage of this lower rate instead of waiting to buy once rates are already lower. See how much leverage you're losing as you wait for rates to drop? Where if you work with a good lender, and my preferred lender offers free refinances for 5 years, completely free, he covers all those costs, you would be able to inherit a better interest rate and buy at the opportune time when you still have leverage as a buyer. This is the best case scenario, and in fact, I just closed with one of my clients last week who said, I'm so glad I chose to buy. I wasn't even gonna think about buying a house until 2 or 3 years after this point. But I showed him this and we looked at the landscape of Nashville. We realized that the longer you wait, the worse a position you're gonna be as a buyer. Now, I'm not saying this to scare anyone. If you're not in a position to buy, don't. Real estate can be a blessing, but it can also be a curse. So if you're not able to make it work with these payments, then you're just not gonna be able to make it work with these payments. But if you are in a position to buy, but you're thinking about waiting for interest rates to drop, you are losing so much leverage. It is going to be much more difficult to get into a house that you like, and you're gonna have to spend a lot more money to do it. I hope this cleared up some of the benefits of buying sooner rather than later. If you have any questions, just leave them in the comment section. I'd be happy to answer those. If you're looking to invest in a property, whether you're a first-time buyer, an investor, I work with primary residents, I work with investors, I work with sellers. If you're doing any of that here soon, I would love for you to reach out to me and we'll walk through your specific scenario. We'll see if it makes sense for you, and I'll put you in contact with my lender so you can take advantage of the great offers that he has. If you found this informative, if you found this valuable, I would appreciate if you would subscribe to my channel. Again, my name is Wesley Meyer. I'm a realtor here in Nashville. I'll see you in the next video. Have a good one. Bye-bye.